Home prices in your city may be falling fast, but the cost of owning that home has never been higher. Property taxes are climbing, insurance premiums are exploding, HOA fees are quietly doubling, and mortgage payments remain locked at punishing levels. What was once sold as a symbol of stability is becoming a financial pressure point, even for people who thought they were safe. This is no longer a story about first-time buyers or modest homes. This is about million-dollar properties losing value while draining cash month after month. Across America's wealthiest cities, sellers are panicking, buyers are walking away, and properties that once defined success are sitting empty. So here's the question. Which cities are quietly making their residents poorer, even as prices fall? To understand why luxury housing is breaking first, we need to step back and look at what has changed beneath the surface of the U.S. housing market. This downturn is not being driven by a sudden collapse in demand alone. It is being driven by a reversal of every force that inflated prices between 2020 and 2022. Interest rates are the most visible pressure point. Mortgage rates that once hovered near historic lows are now locked above levels most buyers had never planned for. Even high-income households are discovering that affordability does not scale cleanly with wealth. When borrowing costs rise this sharply, leverage stops working, and luxury markets depend heavily on leverage. At the same time, migration patterns have reversed. During the pandemic years, households and investors rushed into a handful of winning cities, convinced that remote work, tax advantages, and lifestyle shifts would last indefinitely. Developers responded aggressively. Luxury condos, high-end subdivisions, and investor-focused inventory flooded the market. What was built assumed continued inflows that never arrived. Now that inventory remains, but the buyers do not. Insurance has become the silent accelerant. In states exposed to climate risk, premiums have surged faster than incomes or rents. Homeowners are being forced to absorb costs that were never factored into original purchase decisions. In many cases, insurance alone now rivals mortgage payments from just a few years ago. Property taxes and HOA fees have compounded the problem. These costs do not fall when prices fall. They rise independently, and they rise relentlessly. As a result, owners are discovering that lower valuations do not bring relief. They bring negative leverage. This cycle is fundamentally different from past corrections. Prices are falling, but the growth engine that once justified ownership is gone. Remote work has weakened urban gravity. Global capital has become cautious. Short-term rentals are oversupplied. And climate, insurance, and infrastructure risks are no longer abstract. This is why the luxury segment is cracking first. It is not about taste or status anymore. It is about math. If you want to understand how this plays out in real neighborhoods, real streets, and real households, make sure to like the video, subscribe to the channel, and turn on notifications. Because the next 7 cities are not theories. They are case studies, and the damage is already visible. 1. Dallas, Texas. For years, Dallas was presented as the ultimate proof that the American housing boom had found a safer formula. No state income tax, explosive job growth, a steady inflow of high earners fleeing more expensive coastal cities. Luxury neighborhoods like Highland Park, Preston Hollow, and Turtle Creek became symbols of that confidence. Multi-million-dollar homes were selling quietly, sometimes before they ever appeared on public listings. The belief was simple. Dallas luxury was different. By 2026, that belief has fractured. At the market's peak in 2022, the median price for luxury homes, defined as the top 10% of the market, pushed past $1.3 million. Today, that same segment is trading closer to $1.05 million. A decline of roughly 20% in just 3 years. Homes priced above $3 million are routinely cutting asking prices by $500,000 to a full million, and still sitting unsold. Inventory tells the real story. Luxury homes in Dallas are now sitting at nearly 10 months of supply, roughly double what a healthy market can absorb. Listings that once disappeared in days are lingering for 4 to 6 months. The power has shifted, decisively, from sellers to buyers. But price declines are only part of the pressure. Ownership costs have surged. Dallas County property taxes hover around 2.2%. A $2 million home can generate an annual tax bill approaching $45,000. Insurance premiums, driven by hailstorms and severe weather risk, frequently exceed $12,000 per year. Together, these costs push monthly ownership expenses into territory that challenges even six-figure incomes. Rental income offers no escape. Luxury rentals often bring in around $6,000 per month, while total carrying costs push well past $10,000. What was once marketed as a cash flow play has quietly become an exit strategy. Foreclosures in the luxury segment, once rare, are rising. Dallas still projects confidence. But beneath the surface, the Texas boom myth is cracking. So what happens when a market built on growth runs headfirst into excess? 2. Las Vegas, Nevada. Luxury real estate in Las Vegas has always been built on spectacle. Glass-walled penthouses overlooking the Strip. Hillside mansions designed for short-term guests. Properties marketed less as homes and more as revenue machines. For years, the formula seemed flawless. Tourism was relentless. Airbnb demand appeared unlimited. Investors believed that as long as the lights stayed on, the money would keep flowing. By 2026, that illusion has collapsed. Luxury home prices in Las Vegas peaked in 2022 when the median crossed roughly $1.1 million. Today, that figure has fallen closer to $880,000, a decline of around 20%. Homes priced above $2 million are routinely slashing $400,000 to $600,000 from asking prices, often without attracting serious interest. Inventory has ballooned. The luxury segment now sits near 11 months of supply. Homes that once sold quickly to out-of-state investors are lingering for months, waiting for buyers who are no longer confident in the math. Costs have risen sharply. Mortgage rates above 7% have reshaped affordability even for high-income households. Property taxes on a $2 million home exceed $20,000 annually. Insurance premiums tied to desert flooding and wildfire risk add thousands more. Monthly ownership costs that averaged around $6,000 just a few years ago are now pushing closer to $9,000. Rental income, once the market's safety net, is no longer reliable. Luxury short-term rental bookings are down roughly 20%. Oversupply has driven occupancy lower, leaving many units sitting empty through extended stretches of the year. Investors who once relied on nonstop tourism are now bleeding cash. Foreclosures are beginning to surface in upscale communities like Henderson and Summerlin. The fantasy built on glitter, glamour, and endless demand is fading. When a luxury market depends entirely on momentum, what happens when momentum disappears? 3. Miami, Florida. For more than a decade, Miami sold itself as America's luxury playground. Glass towers along Biscayne Bay, waterfront estates in Miami Beach and Coral Gables, a skyline built to attract global money searching for sunshine, status, and tax advantages. From 2020 to 2022, that vision reached a peak. High-income buyers from New York and California arrived in waves. International investors poured in from Latin America and Europe. Prices surged at historic speed. A luxury condo that sold for $1.5 million in 2019 could resell for well over $2 million just a few years later. By 2026, the momentum has reversed. Luxury condo prices in Miami are now down nearly 22% from their peak. Properties that once triggered bidding wars are sitting idle. Waterfront homes listed at $5 million are cutting prices by $1 million or more, and still failing to attract buyers. The problem is not demand alone. It is supply colliding with cost. Between 2018 and 2024, more than 20,000 new luxury condo units entered the Miami market. The pipeline assumed endless inflows of wealth that never materialized. At the same time, Florida's insurance crisis has turned ownership into a financial burden. Insurance premiums for waterfront properties that once averaged around $15,000 per year now frequently exceed $40,000. HOA fees have surged as well. Monthly dues of $1,500 to $2,500 are now common in high-end towers. Short-term rentals are no longer filling the gap. Luxury Airbnb occupancy has slipped below 55%, while nightly rates are down roughly 20%. International buyers, once the backbone of Miami's luxury demand, are pulling back amid higher U.S. interest rates and global uncertainty. The skyline remains, the ocean views remain, but the market built around them is overextended. When global money leaves, what's left holding the towers up? 4. San Diego, California. For years, San Diego was seen as the quieter alternative to Los Angeles luxury. No Hollywood spectacle, no global hype cycles, just ocean views, clean neighborhoods, and a reputation for stability. For wealthy buyers, it felt refined and safe. That perception is now breaking. Luxury home prices in San Diego peaked around 2021, when the median reached roughly $2.4 million. By 2026, that figure has slipped closer to $195 million, a decline of nearly 19%. At the top of the market, properties priced above $8 million are cutting asking prices by $1.5 to $2 million just to attract attention. Inventory is quietly building. Luxury homes that once sold within weeks are now sitting on the market for 5 months or longer. Sellers are offering incentives, flexibility, and price reductions, signs of a market that has lost its urgency. The deeper pressure comes from costs. Property taxes on a $5 million home can exceed $55,000 per year. Insurance premiums tied to wildfire and flood exposure have surged past $25,000 annually. Mortgage rates above 7% have pushed monthly payments from roughly $12,000 in 2021 to nearly $18,000 by 2026. Rental income no longer cushions the blow. Demand for high-end vacation rentals has weakened sharply. Occupancy rates are now slipping below 50%, leaving many owners unable to cover even basic carrying costs. Rents that once felt generous are now falling short by as much as 25%. As a result, quiet stress is spreading. Families who stretched to secure luxury properties during the boom are now trapped, unable to sell without losses, yet struggling to hold on. Foreclosures are beginning to surface in neighborhoods once associated with permanence. San Diego did not lose its appeal. It lost its margin for error. So what happens when even safe luxury stops making sense? 5. San Francisco, California. For more than a decade, San Francisco represented the peak of modern American wealth. Tech founders, venture capitalists, and high-paid engineers pushed prices to levels that once seemed untouchable. Luxury homes in Pacific Heights and Noe Valley, along with high-end condos downtown, were treated as long-term stores of value. By 2026, that assumption has collapsed. Luxury home values in San Francisco peaked around 2020, when the median approached $3.5 million. Today, that figure has fallen closer to $2.75 million, a decline of roughly 22%. The downtown condo market has been hit even harder, with prices down nearly 30% from their highs. Inventory is the clearest signal of distress. Luxury condos that once sold within days are now lingering for more than 200 days on the market. Entire buildings remain partially empty, even as sellers cycle through repeated price cuts. The root causes are structural. Large-scale tech layoffs have reduced the population of high-income buyers. Remote work has drained demand from downtown living, weakening the core logic behind luxury towers built during the boom. At the same time, ongoing concerns around crime, homelessness, and quality of life have further narrowed the buyer pool. Costs have only deepened the pressure. Property taxes on a $3 million home exceed $35,000 per year. Earthquake insurance premiums now push past $15,000 annually. HOA fees continue to rise even as values fall. Developers are scrambling. Incentives have become increasingly aggressive. Waived HOA fees, premium upgrades, and financial concessions once unthinkable in this market. Still, demand remains thin. Luxury rents are down nearly 18%, erasing investor confidence. Foreclosures are beginning to surface quietly, even in exclusive neighborhoods. San Francisco's decline is not just a housing story. It is a warning about what happens when a city ties its fortunes too tightly to a single industry. When tech slows, what's left to support the price? 6. Los Angeles, California. For decades, Los Angeles stood at the center of America's luxury mythology. Beverly Hills mansions, Malibu estates perched above the ocean, streets where wealth was not just accumulated but displayed. Luxury here was not about utility. It was about identity. By 2026, that identity is under strain. Luxury home values across Los Angeles County peaked around 2021 when the median reached roughly 3.2 million. Today, that figure has fallen closer to 2.55 million, a decline of about 21%. At the very top of the market, properties priced above $10 million are cutting, asking prices by 2 to 4 million just to generate interest. Multiple pressures are converging at once. Years of speculative overbuilding created excess supply. Mortgage rates above 7% have turned monthly payments on $15 to $20 million estates into staggering obligations. Even for wealthy buyers, the math no longer feels rational. Insurance has become a breaking point. In wildfire-exposed areas like Malibu, annual insurance premiums now exceed $100,000. HOA fees in gated hillside communities have surged as well, sometimes doubling within a few years. These costs continue to rise regardless of market conditions. The buyer pool is shrinking. Layoffs and reduced production across the entertainment industry have cut into the number of high earners willing or able to purchase. Foreign investors, once a dependable source of demand, are pulling back amid tighter global financial conditions. Short-term rental regulations have further eroded investor strategies. As a result, something once unthinkable is happening. Banks are beginning to repossess multi-million-dollar homes. Streets that once symbolized limitless success now display price reduction banners instead. In Los Angeles, the illusion of endless demand is fading. If status becomes too expensive to maintain, how long does it survive? 7. New York City, New York. For generations, New York City represented the absolute peak of global wealth. Owning property here was not just an investment, it was a declaration of permanence. Penthouse apartments overlooking Central Park, townhouses on the Upper East Side. Glass towers built for billionaires who believed scarcity alone guaranteed value. By 2001, yet, that assumption has broken it. Luxury home prices across New York City peaked around 2020, when the median reached roughly 4.5 million. Today, that figure has fallen closer to 3.5 million, a decline of about 21%. At the extreme high-end, ultra-luxury penthouses that once carried $50 million price tags are slashing 10 to 15 million and still sitting unsold. Inventory has exploded. The ultra-luxury segment is now facing nearly 14 months of supply. For a market once defined by scarcity, that number is staggering. The cost structure has become oppressive. Property taxes on a $10 million condo can approach $200,000 per year. Monthly HOA fees routinely exceed $5,000. Insurance premiums continue to climb. Mortgage payments on $20 million properties have reached levels that even the ultra-wealthy are questioning. Demand has dried up. Wall Street bonuses have shrunk. International buyers have pulled back. Remote work has weakened Manhattan's gravitational pull. Entire luxury towers now sit partially empty, their darkened windows reflecting a market that overshot reality. Rental income offers no refuge. High-end rents have softened, vacancy rates are rising, and investors are quietly unloading properties at losses. Foreclosures, once unimaginable in Manhattan's luxury market, are beginning to appear. New York's skyline still stands, but the wealth logic that built it is changing. When even the world's richest city cannot sustain its luxury prices, the question becomes unavoidable. What happens next? Taken individually, none of these cities tells the full story. Dallas, Las Vegas, Miami, San Diego, San Francisco, Los Angeles, and New York each have their own histories, industries, and identities. But together, they reveal a single, uncomfortable pattern. Luxury housing in America did not collapse because people stopped wanting beautiful homes. It collapsed because the math stopped working. Across every market, the same forces appear again and again. Prices surged on cheap money, migration optimism, and speculation. Developers built as if demand would never slow. Investors assumed scarcity would protect them. Buyers stretched further, confident that values could only move in one direction. Then the environment changed. Interest rates rose and stayed high. Insurance premiums exploded. Property taxes and HOA fees climbed independently of home values. Remote work weakened urban gravity. Short-term rentals flooded the market. And global capital, once eager, became cautious. What followed was not panic, but pressure. Sellers began cutting prices, not because they wanted to, but because holding costs became unbearable. Investors quietly exited at losses. Foreclosures surfaced in neighborhoods where they were once unthinkable, and the long-held belief that luxury real estate was immune to downturns finally cracked. This matters far beyond million-dollar homes. Luxury markets always move first. They are the most sensitive to leverage, confidence, and excess. When they weaken, the signal travels downward, slowly at first, then all at once. So the question is no longer whether this is happening. It is whether this is a temporary correction or the beginning of a longer reset in how Americans think about housing, wealth, and risk. If these stories helped clarify what's really unfolding beneath the headlines, make sure to like the video, subscribe to the channel, and turn on notifications. And if you live in one of these cities or see similar signs where you are, share your experience below. Because the next chapter of this housing cycle is already being written, and not everyone will be prepared.